Dear colleagues, our keynote speaker for the noon session today has a remarkable journey in the financial industry. Please join me in welcoming Dr. Anders Stenkrona. Dr. Stenkrona, varsågod.
Now, yes, with technology, we love it. Okay. Well, I'm very excited to be here, and thank you so much for all the interesting discussions we've had. I've had several with many of you, and thank you for being here and, you know, helping us all get a little bit smarter and brighter. Now, my work in academia, and it's so I got my PhD back in 2007 at Stockholm University. So my background is in academia, and I love academia. But I went out to work in the banking industry for money, I guess. But I've always had an academic mindset, and it's been very, very profitable for me to have that. Because being schooled academically and being able to structure problems, understand how to handle different alternatives has been very, very good. Entering a room and kind of dissecting problems that we have has been fantastic. So it's been a really treat for me to have that throughout all my career. And thankfully, I've managed to have some little bit of foothold left in the academic world. So I've been teaching a little bit at the university off and on during the past 20 years, which has been a real treat for me as well. And coming back to a conference like this brings back memories, saying, yes, this is where knowledge is born. You know, we try to understand where's the really edge of what we know, and what's the next thing. And that is so much fun. In academia, it's a real privilege because you can, take a step back and you can look and you can try to dissect. And what academics we do, we try to understand, abstract, and find principles that are applicable somewhere else, right? That's what we do. In the industry, we're right in the thick of it. We try to apply it and make it work. And I'm going to take you through a journey. This is kind of like a fast forward over the past 5 years, what's been going on. And this is going to be more of a case study where we go from the grassroots and up, or specifically one grassroots right here. What happens and what kind of problems and what hinders are on the way. And I need to pivot stuff. And you're going to recognize that in your own research. I mean, you're basically all entrepreneurs when trying to sell your ideas. And that's mainly what's been going on in the industry from my point of view. So a little bit of how we came to this financial well-being, a case study, what led me to this. In part of my career, we built a robot advisor. You know, one of these financial advisors, you can go in and just answer a bunch of questions and say, invest in that fund, for instance. One of those. We built one of those. And my ambition when we built that is that investments is just a small portion of your financial situation. It's just this. I want to build something that is more holistic and comprehensive so that it can give you financial well-being or financial health. And Nordea caught on to this idea and said, well, come on to us and let's see what we can do. And so I started at Nordea helping out with the digitalization of the company, basically, and working with their robot advisor, and then seeing how can we expand the robot advisor to be more than just an advisor of investment, but more of a financial health tool. So that's where we enter stage right now. So in my work, I have so a little bit, again, what I do right now. So I'm the private economist at Nordea. Nordea is one of the largest banks in the Nordics, or pan-Nordic, it is the largest bank, but in Sweden we're one of the biggest, one of the big four. My job is to interpret what happens in the macro world with interest rate changes or whatever, inflation, and interpret that to how does that apply to people, like you and I, on a personal level. And then I communicate that to media, basically. So that's what it is. So this evening I'm going to be at Channel 4, if anyone's here listening. Anyway. So that's what I do on a daily basis. And this has been with me for the past 5 years since I started at Nordea and trying to develop and implement this model of financial well-being digitally. So it's in everyone's pocket. Here we go. So I speak to a lot of people about their finances. And I say, well, what's your finances like? What do you do with your money? And they say, well, it's great because I get income because I work, and then I spend that money, and then I get more income because I work, and then I spend that money. This is quite typical, from hand to mouth, from hand to mouth. And they say, well, that's okay, that's good. You can sort of manage your bills. Do you save anything? And I can get responses similar to this, saying, well, I never have money to spare, so I can't save money. What do you mean? Sort of like that. And I provoke them a little bit, say, well, you know, why don't you save? Well, they say, well, I'm drowning in expenses. How could I possibly save? These comments, you can sort of understand them now when we've had a great deal of inflation, where the inflation has been a lot more and interest rates have been raised a lot more than your salary has been raised. So your margins have really shrunk. But we heard this way before when interest rates were like 1.5%. So the interesting thing is this: they have money to pay their bills today too, but they didn't have money to save then. So it just wasn't popular. They didn't see the need to, but they would rather pay expenses. So no, I'm drowning in expenses. I said, all right, well, how could you save then? Well, you know, some bills seem to come out of nowhere. I don't know if you've experienced that. Some bills come every quarter instead of every month. Some bills come every 6 months. Some bills come once a year. And that can happen to me too. I'm looking at my bill and saying, this month will be great. And then all of a sudden you get your, car insurance. Say, I already paid that. Oh yeah, that was a year ago. So, some bills come out of nowhere, which makes it more difficult to save. Or this: if something breaks right now, I'm done. Nothing can break. And these comments are the typical epithets of not financial well-being. Being constantly worried about your personal finances is not a fun thing to go around doing. And this is more of a caricature right here, but sometimes it feels like this. You might agree. Hooray, I just got paid. Now, let me just pay some bills. And now I'm broke. Sometimes we might recognize portions of this in our life. And I definitely hear it, and sometimes I only hear the bad stuff, but this is around. So our goal was really to say, how can we create a model that helps our customers to have a good, healthy financial situation and experience financial well-being, so that finances, these things, are a thing of the past, so that we have our buffers in place and so forth. So I went out and started to create a model, and since we're academics, let's just have a look. We did a survey, and I thought this was quite interesting, where we said, how optimistic are you about your financial future? And then they could rate themselves from 1 to 7, okay? And then the scale was actually in not 1, 2, 3, 4, it actually turned out to be a nice scale, so you can do OLS regressions on this. Anyway, how optimistic are you about the future? And then we also asked them a bunch of other questions, of course. So we asked them, how much in control do you feel you are in about your finances? Okay, I can't point. Sweden, Norway, Finland, Denmark. The top one there says the one thing that was significant in all countries was control. Control mattered. The more control they said they had, you see it's a positive, significant variable. The more control they said they had, the more optimistic they were about their financial future. That is a good find. Okay, we want to help people get in control of their financial future. An interesting aspect that we didn't really think about, but we asked them about their income as well. And to no one's surprise, the more income you have, the more optimistic you are about your financial future. That seems reasonable. But look at the coefficient size. If you look at the control coefficient, it's 0.34, and income above 700 compared to income around 500. So if you have 500,000 crowns a year, actually 300 to 500, and you have 700 instead, that is 200,000 crowns more. That's about $20,000 more. So let's say you earn $20,000 more a year. Yes, that makes you more optimistic about your financial future. How much more optimistic? 0.35, 0.34 on control. It's about the same size. So what I tell people is, if you get a real hold on your financial situation, control, it's emotionally like getting a pay raise of 200,000 crowns or $20,000. It's not bad. It's economically significant to get in control of your finances. We got similar pictures in both Finland, Norway, Denmark, and Finland, Norway, and Denmark. So it's not isolated to Swedes that we like to be in control, but it helps us. So it sells in the case that being in control of your finances will give you a better, more optimism about your financial future to the degree of a significant pay raise. It's nice. So we set about making a model somehow. Or rather this, what if we're going to make a model, if we're going to make some kind of an app or something, digital tool, where does it fit in to the infrastructure of all the digital tools that you use today? Now, I want to do a little mini survey here and say, how many in here have one, and raise your hand if you, and keep it up, have one, at least one digital tool that helps you with your finances in any way? One hand up. Okay. Everybody uses some type, except the Greek. Zero. It is paper and pen, go to the bank. I love you. Okay, that's semi-digital. But yes, I love it. Yeah, I remember the days when you wrote down on a piece of paper and posted it, said, these are my bills. Okay, but keep your hands up. I want to see this because this is interesting to me. How many in here use 2 apps to somehow manage their finances? Okay. You're like, gonna run out of hands here. One's enough. How many use 3 apps? Okay. How many use 4 apps? Okay. Yeah, and you're starting to think, right? Am I? 5 apps. Okay, sort of. You realize somewhere there's an app fatigue. Do you follow me? So there seems to be a limit around 3, 4, 5 apps. Then it's becoming too much. So really, let's just look at what a typical Swede, I'm a typical Swede, has. Now, one thing that every single Swede has, because you can't do anything if you don't have it, that's called Bank ID. That is an ID application that, it's secure towards banks, and if it's secure towards a bank, it's secure towards anything. So basically, everything you do online, you have a bank ID to identify yourself. So that's one. And then we have the bank app. And I will count this as 2 separate apps. Okay? And then we have something in Sweden where if we're going to give people, if I'm going to give you cash, can you send 20 crowns to me, or can you do this? We use something called Swish. It's incredibly easy. It's a way to just, instead of giving each other cash, we give through this. And you have, I'll bet many countries have something very, very similar because it's so convenient. So bank ID, Swish, okay, that's 3. And then we have something in Sweden called Klarna. This is where all my bills, or most of my bills, show up in this app, and I say pay, 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 and they're paid. And that helps me a lot. So that's 4 apps. And then I have some Apple Pay. That's actually an app. And then we have credit card app, something like that. So this is typically what you have. And the question is, a personal financial management tool, where would it fit in? Would there be enough attention to create a separate financial tool, personal finance tool, or should we somehow bake it in to the app that you already use? Well, the vote fell on, we need to bake this into the existing app so that there's one app. And we have at Nordea, we have about 1 billion logins per year in this app. So it's very well used. So we said, let's put it in there. And that's when I started to experience what's called a backlog. The developers of the app say, that's a great idea. We just have all of this that we need to do, and then we can start to think about what we're discussing here. I'll show you how that journey went. Maybe the best evidence for me that a separate personal financial management tool was not the way to go is that in Sweden there was a company, or it still is, a company called Tink. You probably have not heard of it if you're outside of Sweden. It was a very well-developed personal financial management tool. It sucked in information from all the financial institutions that you were linked to, sucked it in, and structured it really nice. This is what you're spending on. This is your well, different things you could do about organizing your financial situation. Not enough people were willing to pay so that they would become profitable. Some did, but not enough. So it's hard to get people to be involved that much in their finances, to actually invest time and money to structure it in that app. And it was a good app. They pivoted to becoming a data provider company to help companies like us to find and provide the data that we want. But they could not make it as a personal financial management tool. Therefore, we said, let's bake it into the app, and then you can get notices. Say, if you want to have a good financial situation, do this. Or this is the no-brainer for you. The easiest, lowest hanging fruit for you, do this. Your budget or your savings or whatever. So when I came into Nordea, I had just developed this app. And basically we said, yeah, people get money and then they spend money. What they should be doing, and I started to talk about how to develop a cash flow model, much like when you're going to analyze a business. And we said we could automate this and we could help people understand their financial situation without having to lift the hood. We could just give them notices, what's good. So we say this, instead of everything going out towards nothing, you should save a piece of your money and have your own sort of net wealth, your own equity, if you put it that way. And we start to create a balance sheet. Your net wealth is put into assets. So now we're creating a balance sheet of equity loans on one side and assets on the other side. We all know this. And you might want to take a loan to buy a house, and you might want to take a loan to buy a car, and all of a sudden you have a balance sheet. Balance sheets cost money, right? Because all of a sudden bills start coming from out of nowhere. So all of a sudden you have to pay interest on your loans, and your car breaks down, and so forth, so you have less to save. Well, we want to make sure that your assets are invested in something that actually gives you some kind of positive cash flow or positive return, so you can get a little bit more left after you pay your bills. This is about as simple as you can make a cash flow model if you're trying to explain it to non-academics or non-bankers. So when my boss saw this, he said, that's great, we should do that. When I tried to explain this to the designers, what do you think they said? They said, what? They did not understand. The real coin dropped when I did this, and it took about we had like a sprint with the designers. I think we were there a week. And at the end of the week, one of them said, oh, I think I know what you mean. And that's when when I really realized there's no way a person on the street understands this, unfortunately. And the designers didn't understand it, but the data people, they loved it. They said, this is great, but we can't. This is back in 2018, 2019, somewhere around there. We love it, but our data lake with all this data, we can't, the data isn't collected in a way that we can do this right away. But keep it in mind, one day we will. Okay, what do I do in the meantime? Sell it. So here comes the process from grassroots level to try to sell this idea. So people internally buy it, they understand it, and say, that is a good way to go about this. How can we help our customers closer to this? So I spent a lot of time saying, how can I, first of all, simplify this? Because essentially what we want to do, we want to say, save money. And we came to the conclusion that 10% in Scandinavia is a good portion to save, because it's not too much and it's not too little. And it turns into a quite significant amount of money within a reasonably short amount of time. So we discussed with a lot of advisors, and a lot of the different countries said, what's a good level? 10 seems to be a good level to save. But what should you save for? And what? Is this a big bucket? Just pour it into a big bucket? How should we manage this? So we came up to the conclusion, so let's do 5 things that we focus on. And I structured it this way. I said, right. So if we just look at someone's finances and say, first of all, you need to get a budget going. Okay? So that's the yellow one. And the budget will help you with your savings, your investments, and your loans. That's essentially the raw components of someone's financial situation. So we say save 10%, make sure that your needs, the ones that you have to pay or you have to move, those should not be more than half of your cash. You need to have simple rules of thumb here. And the rest of the money can go to whatever you want. It's just an easy way to put it. Now, if you start by saving, that's number one. The budget helps you save. The money, first of all, goes to an emergency buffer. So if something bad happens, if your car breaks down, you lose a tooth, or your cat dies, whatever it is, you have the money to handle that, emergency. And sometimes you want to, sugar that with some insurance as well. And most people want that so that you don't go bust. Or really, if you do not have an emergency buffer, you have no money, and an emergency happens where you need the money, you have to take an unfortunate loan, an expensive loan is usually what happens. So the next step, once you have that in place, the next step is to make sure that the expensive loans that you had, take care of them, get them out of the picture. An expensive loan is typically a loan that costs more than the interest rate will give you, than any return will give you, reasonable return. So the average return on the market, what would that be? Academics, what would you say? Where's the average return on the market approximately? Say 8, 7, 10, somewhere around there. If you take the historical average, including dividends, we're up at 10%. If we take some kind of a long-term average, we're at 7, 8, right? So if you have a loan that costs more than that, there is no better investment advice than to get rid of that loan. We all agree. So once you've done that, then we take a look at the safety buffer. And that's sort of the emergency buffer, that's emergency cash for if you lose a tooth or something really has to be taken care of now. And a safety buffer is more of this type of if you lose your job or if you have to take leave for a while for any reason, how much money do you need until you can get a new job? Typically, what would you say? A couple of months? Yeah? Some say 6 months. We live in Sweden with a big safety net, 2 to 3 months. So this depends on where you are, what kind of job you have, and how much, how much you would get if you lose. Like in Sweden, you typically get a month or two severance pay, which means that I have a month or two covered, and then I have a month or two with my own money, and that means 4 or 5 months down the road, I'm going to get a job. So it really depends on your situation, but a nice safety buffer. Once you have that, your current situation is under control and you can breathe. You don't have to say, nothing can break, right? Because that's a tough situation to live in. But if you can say, it's okay, then you're okay. Once you do that, you look at the future. What we would argue is the most important investment for your future is your pension. So your pension investments, are they on track? And then after that, you say, well, any long-term or short-term investments, happy day. So I took this to the designers and said, how about this? They said, oh, yeah, we might be able to do something with that. But it needs to be more sellable. It needs to be easier for anybody to be able to repeat. So you know that a hit song, you've all heard hit songs, right? And sometimes they're even annoying. But a song becomes a hit if when you hear it, you can sing it to someone else, right? So it needs to be easier than this. Okay, let's make it easier. And we did buckets. So this is how we did it, the bucket model. So right, okay, so now we're down at the level where we actually can start to communicate this to our customers in an easy way. So I said the first step is to turn on a faucet. You got to budget your money so that when you turn on the faucet, money starts pouring into your finances. So you don't just, you can't get rich by making everybody else rich. To gain a fortune, you need to, stop making others rich and focus on yourself. So the first thing you do is save 10%. Just pour that into your own buckets. And the first bucket that you make sure is filled up always is the emergency cash. This all depends on what kind of lifestyle you have. And we've had a bunch of workshops where we ask people, how much money do you need? But if you want to convert it to dollars, just take away a zero. $1,000 to $3,000, $10,000 to 30,000 crowns, covers for most people in an emergency. I lost, except if you own cats, I've learned. If your cat gets sick, to fix a cat costs a lot of money. So you need more. But for a normal person, this covers about most of it. And it's not that hard to get. Make sure you have $1,000. That's the first thing you do. And you always have $1,000 in your account that you can just hand. It should be a little bit harder to get it than just pressing a button. You might have to press 3 buttons to get it, but it should be there. It should be very accessible. But you don't risk spending it on candy or ice cream, because that's not an emergency. Right, so emergency cash. And maybe not maybe, but insurance is very good to have there too if you break something really expensive. You don't want to live without that. Once you have that, you take care of the expensive debt. That's your job. There is no better investment alternative than to get rid of the expensive debt. Once you're cleared that, then you look at getting a little bit of a bigger buffer. And remember, these buckets are always filled from top down. So if in mid-journey an accident happens and you expend your emergency cash, you start over and you fill that first. And then the hierarchy goes down. That's what makes this easy. And it works. So when your buffer is done, then it starts to spill over, and then you say, pension, are you on track? Doesn't mean you have to be finished with your pension savings, but are you saving enough so that when you look at your prognosis, you're going to have enough money when you retire? And we have some good rules of thumb there, but I won't spend time talking about that. So are you on track with your pension? And then once you have those, you look at what are your dreams? And then some say, oh, it takes so long until I do this. No, it doesn't. And you don't want to live without emergency cash or a buffer. You want that in place. If you have expensive debt, you're never going to reach your dreams. You're going to fulfill other people's dreams by paying the debt or by paying the interest. Get rid of it. So these are really basic steps, and it's as basic as we can make it without making it insignificant. This is actually significant. My question to you, we have a few minutes, what bucket do you think makes people's eyes go, oh yeah, I should do that? There are 2 buckets that make people go, oh yeah. Which ones do you think they are? Dreams. Surprisingly few have dreams. I don't know what I'm going to save for. I say, well, you're not going to be sad. I usually say this. Has anyone here experienced at the end of the month when you look at your account and say, oh my gosh, what am I going to do with all this money? It's not an unpleasant thing. So that's good. But that's not where they really get, ooh, like this. Which one do you think it is? No. Pension. Pension is what really catches their attention. And we put it up in a way where we say, you should have 20 annual salaries in your pension account when you retire. And I go, what? 20 annual salaries? Yeah, it's easy math. If you get 5% return, then you can live off the returns. Because 20 annual salaries, 5% is 1/20th. We're academics here, we know that. So 1/20th, that means that I get 1 annual salary per year and leave the principal alone. 20 sounds like a lot, but the professionals, the real pension industry, has a number of, I think it was 18.69. That number is harder to remember, and it's harder to do division in your head by 1869. But 20, easy to remember, and it's graspable, and it makes people's jaws drop. Say, oh my, I need 20 annual salaries? Yes, you do. Or that's what you should aim for, and that gets them excited and say, okay, I should do this. Help me out. It's all sales. But it's important to get to that level. So pension, and then there's one more that actually gets them, oh yeah, I should have that. That's actually buffer 2 to 3 months. It's a quite boring one. And people say, but I'm never going to lose my job. Well, you don't know. You might actually have to call in sick for 6 months because you're dead. So the thing is, when we do this, so the next level of doing this, when I sort of presented this, I say, we love it, that's great. Let's start to try to make this more known in the bank. Well, then we started doing road shows, and we took out pamphlets like this. I wrote a book about it, say this is how you get insider secrets to financial well-being. So we try to put some, some sugar around it, and say, some structure and some meat on the bones. And so that when people came to the workshops, and we had like 25 of these, they get this pamphlet and they write down with pen and paper to really make it analog. So this is what it is. Where am I with my emergency cash, and so forth and so forth. And it's been a terrific journey. And lo and behold, I think it was 2 or 3 months, maybe 2 months ago, The digital guys came and said, you know what, now we're actually getting prepared to digitize this in the app. I say, oh, terrific. So this is what a journey is like. There are pivots on the way. You have to get buy-in from all the people in the bank, and then eventually you have to get sell it to the customers, and it grows. So thank you.
Thank you so much, Anders, for the presentation and for all of these tips. I was thinking, what should I do next now after this presentation? Yes, we have time for Q&A, so yes, please.
Thank you very much for your presentation, because it gives me the chance to see the market points of view about a very hot topic which we have been talking about, which is the broad idea of robo-advice in this respect. And I'm a former regulator, so I understand this market point of view quite well. However, I'm not clear about what is exactly the model. Let me say something very simple. We have a model of robo-advice that typically was developed to apply in standard financial investment. There you have the customer, you get his profile, you determine his overall risk tolerance, his overall capacity to withstand risk, and so on, so forth. And then you have the optimization algorithm analyzing different financial assets, getting the risk-return trade-off each one, and matches the profile with those risk-return trade-offs and come up automatically, based on a robo process, on an optimization algorithm, what should be a good advice for you without all the costs and blah, blah, all these things. That's fine. You're presenting a wealth management approach, which is fine, and I understand it from the point of view, but I have difficulty to understand what you are optimizing here, because you have clients that they have fixed income coming from a salary. They have pretty much fixed expenses. So in the end of the day, may not be. So essentially what I see that could be an area of optimization is the relative cost of the different applications. I'm trying to understand what is the advice that the bank will offer, what will optimize to create value for the customer in this respect. Because it's not just a step obvious to say, save 10%. Yeah, I know this. Why do I need you to tell me that? So I'm trying to understand what is exactly, from the bank's point of view, the product that you are selling in this respect.
Very good question. Now, for the bank's point of view, we don't make hardly any money for the first 3 buckets at all. So it's really to serve a customer to feel better about their finances. The business case for the customer is in the first slide where I showed that people say, nothing can break or I'm done. That sort of feeling. Or I can't save any money because I have no money left over. So helping the customer feel more in control of their finances, and that's something very real. Feel control of their finances will give them a sensation equivalent to a significant pay raise. So they feel better and more optimistic about their future if they have a sense of, where did my money go? It just poof, disappeared. So helping them structure a way so that they, first of all, can save, build their own fortune. Second of all, what should they save in? Is it just a big bucket? No, let's do it one step at a time, that you can handle an emergency, that you stop making other people rich, but take away the expensive debt, that you can handle if you lose your job, that your pension is on track. Those things that concern people, and it's in the back of their head, but they have no... sometimes when you have so much to do, you just don't do anything. But if you break it down in buckets, it's easier to do one thing at a time. And then all of a sudden, after 6 months, because it takes a while to get these buckets filled, you say, I'm actually on track. And it gives a sensation of being financial well-being, actually. So that's what we're selling.
You are very clear now, and I get it. But now my next question is, and I'm sorry.
Sure, go.
Do you need any optimization process? You can do it personally.
You can do it personally. People do, yeah. Certainly. You can do it personally, but the thing is, most people, well, no, I say many people do. All don't. And sorry. Thank you so much. Okay, well, Sorry.
Research, we need to move.
Appreciate the question.
Yes, please. Thank you so much.
I have a question about whether there's a disconnect between the feeling of financial control versus actual financial control. So is there any objective measure, maybe based on this ladder or different ranks, that we can have the bank has a something approaching objective evaluation of control? I would imagine to sell the product, you want them to feel in control. So is there any disconnect, and how reliable is the self-evaluation of the client that they're in control versus actual control?
It's a very good question. Now, in the first regressions that I showed, they're completely self-evaluated, so you have to take it from that basis. But it seems to be enough evidence that if you feel you are in control, you feel more optimistic, and we're okay with that. When it comes to measuring your actual control, so let's say we have an emergency cash of $1,000. For me, that would be completely insufficient. Okay. Because I have 5 kids and a house and 2 cars and a boat. It just wouldn't be enough. I have to have more. Whereas a student, $1,000 might be way too much because they hardly have anything that could break. So it comes down to an individual situation where we say, these are the rules of thumb. You know, $10,000 to $3,000 seem to be good for most people. But the question that we ask is, if something breaks in your home, what would it cost you? Basically. So it has to be modified to really, if it's going to be tailored and fit. Same thing with the buffer. If you lose your job, how much money would you need until you get a new job? And that's also quite individual. 2 to 3 months salary is a good rule of thumb to get them going. But for some, it just doesn't fit. And therefore, we ask the question that way. Same thing with the pension. We don't say, this is how much money you should have for your pension, because it's very individual. But 20 annual pension salaries gets their mind going. Say, okay, that's a good aim. That's a good rule of thumb. So you're very correct. It's hard to get a quantitative number. We can actually say this guy has a good financial well-being, but we can get rules of thumb. And if they're guided in how to, answer their own questions, we can get pretty close.
Thank you. We will move to the last section of this session.
Hi, Stefan.
Yeah, it goes direct to the thing.
Oh, yeah. Hi, thank you. This was really interesting. I think many of the points you raised would even probably apply more to societies outside Sweden, such as the UK, because in the UK, people live much more paycheck to paycheck, and their level of financial budgeting and control is quite low compared to what I think Scandinavians probably do. The thing I wanted to say is another feature you can add to your app is a program called Save More Tomorrow.
Yeah, I love it.
Bernard Taylor,
Yes.
and the idea is inertia. So every time you get a salary bump, you kind of have agreed to save 2% of that, for example, into that. Let's call it a separate buckets.
No, but that would be one of these, so that 10% might increase or something like that.
Yeah.
Or 10% would be the same because you're going to save more because your salary is higher. But I love Save More Tomorrow.
Exactly. So you're familiar with that.
Yeah.
Great. Okay.
No, that was one of the first things I came to the bank, said, we should do this. And I said, how do we do this? But I love the concept, yeah.
Brilliant. Thank you.
Yes. Thank you so much. Thank you so much one more time.
Thank you.
Thank you.
Thank you
so much.
Appreciate it. Thanks. Beautiful.
Yes.
Terrific. Oh, thank you.
Yes.
Thank you.
Thank you.
Thank you. I'd love to discuss afterwards as well. Thank you for questions.
Thank you so much for following us, for our colleagues via YouTube channel. Thank you for the conversation and the question. And we will continue the program. Thank you.